What does it really take for a consumer goods company to, not just survive, but really thrive and keep innovating in a market as, well, dynamic and competitive as India? Today, we're taking a deep dive into exactly that, focusing on Jyothy Labs Limited. We've looked at their latest quarterly earnings, the investor presentations, the earnings call transcript, even a specific valuation report.
Yeah, and our mission today really is to cut through all those numbers, the management talk. We want to get to the heart of the business, understand its financial pulse, how it's actually planning to grow, and crucially, what hurdles it's facing right now. We're looking for those key insights, connecting the dots, trying to find those aha moments for you, our listener, so you really get a clear picture.
Exactly. And the sources we have, those earnings reports for FY 24-25, the Q4 investor deck, the call transcript, that valuation report, they're packed. We're going to explore what they tell us about the company's journey and its strategic direction.
Yeah.
So let's unpack this. Maybe start with the basics. What exactly does Jyothy Labs do? What are their main areas?
Okay, sure. So Jyothy Labs is a pretty prominent Indian FMCG company. FMCG, fast-moving consumer goods. Their focus is really squarely on daily essentials, stuff you find in most households. They operate mainly in 4 core segments: fabric care, dishwashing, household insecticides, people often call it HI, and personal care. And within those, they've got some really dominant brands you'd probably recognize: Ujala in fabric care, Exo for dishwashing, Maxo in HI, and then Margot and Jobia in personal care. Big names.
Right, Ujala especially. So how does a company like Jyothy Labs set itself apart? I mean, they're up against giants like HUL, Dabur, Marco. How do they compete?
That's a really crucial point. It gets to their strategy. Historically, they built strength in specific niches. Like you said, Ujala, it's practically synonymous with fabric whitener, a clear leader there. But while they have that stronghold, they've also been working hard to, expand acceptance for their other core products. Their strategy seems to be this mix of concentration, leverage in Ujala, and diversification. They're actively launching new things.
Okay, diversification makes sense. But given how tough the FMCG market is, are these new launches just sort of keeping pace, or are they genuinely strategic moves for the future? What new stuff have they brought out?
Well, they've had quite a few interesting ones recently, positioned as pipelines for growth. Things like Ujala fabric conditioner, Jovia beauty soap, also Maxo-Aerosol and a Maxo electric racket, even something called Ujala Young and Fresh. And the early feedback seems pretty encouraging. It suggests they're good at finding and filling these white spaces in the market. Maybe hitting needs the bigger players overlook. Adaptability seems key.
Interesting. And what about reaching customers? Urban versus rural distribution?
Yeah, management mentioned a bit of a split picture there. Urban demand has been sluggish. Rural is showing signs of recovery, which is good, but it's not quite enough yet to fully offset the urban softness. But distribution-wise, they've been incredibly active. Their indirect reach up by a massive 800,000 outlets in FY25.
Wow, 800,000.
Huge number. And direct reach also grew by 100,000 outlets. Plus, they're working on improving their wholesale presence, which is, vital in India. And they're definitely responding to consumer needs, launching more affordable formats, like sachets for liquid detergents, and trying to fill gaps in their product range or price points.
So it sounds like they're being really agile, constantly tweaking things to match what people want right now. Essentials, convenience, value for money.
Precisely. That ability to adapt seems to be their edge, really, responding to those evolving preferences.
Okay, we've got a handle on their market strategy. Let's switch gears to the financials. How does all this translate onto their balance sheet? How financially robust is Jyothy Labs?
Right, the numbers. Well, their FY25 results show resilience, especially given the tough environment. Q4 consolidated revenue was rupees 667 crore. That's about 1.1% value growth year on year, but importantly, 4% volume growth.
So volume's outpacing value. That tells a story.
It does. Suggests they're pushing for market share. For the full year, FY25, it was 3.3% value growth and a solid 6.4% volume growth. Profitability. Okay. Gross margin in Q4 was 49.2%. That did show some input cost pressure. But for the full year, gross margin actually improved by 100 basis points to 50.1%. It's a good cost management there. Operating EBITDA margin, basically core operational profitability, also improved in Q4. It hit 16.8%, up from 16.4% the year before, helped by cost control. Full year EBITDA margin was 17.5%. And PAT, net profit after tax, edged up slightly to just under rupees 370 crore. They also managed their A&P advertising spends. It was 8% in Q4, 8.4% for the full year. Sort of calibrated, responding to the market, but still investing in brands long term.
What really jumps out is their capital discipline. Being debt-free with that much cash?
What does that actually allow them to do strategically?
Oh, it's incredibly powerful. Being completely debt-free is a major strength, especially now with higher interest rates. And they have this robust cash balance over rupees 750 crore. I think the Q2 number was specifically rupees 757 crore. This isn't just padding, it's strategic flexibility. They can jump on organic growth opportunities, invest in their business, or even look at acquisitions without needing to borrow. It gives them agility.
And speaking of strategic choices, they decided to sell their stake in the Bangladesh joint venture, JKBL. It resulted in a small loss, right?
Yes, that's right. They divested their 75% stake for about rupees 2.1 crore, leading to a loss of around rupees 4 crore, booked as an exceptional item. Management basically said that after more than a decade, it just wasn't delivering the expected results and was taking up too much focus. With better opportunities seen in India and export markets like the Middle East, Southeast Asia, the board decided it was better to exit. It's a practical move, cutting losses. And they also recommended a final dividend of rupees 3.5 per share for FY25. So balancing that cash generation and dividend history with future growth needs.
Right. So for you, the listener, this paints a picture of a company with a really strong balance sheet, a lot of financial flexibility, ready to invest strategically, but also keen on returning value to shareholders. A balanced act. Okay, so building on that strategy and the solid financials, the key question is growth. How are they actually growing? And does it look sustainable? Can they keep scaling?
Yeah, let's break down the growth drivers. We already touched on that gap between volume and value growth, about 2-3%. Management sees this continuing near term. It's driven by competition, offering more grams per pack, promotional offers, basically prioritizing market penetration right now. Looking at specific categories, fabric care grew 5% in FY25, mostly volume-led. Liquid detergents were the star there. Revenues nearly tripled. And Ujala IDD detergent powder actually gained share in Kerala up to 24.5% in FY25. The whole South India liquid detergent market grew 27% year on year. That's significant. Tripling revenue in liquid detergents is huge. What about dishwash and personal care? Same kind of story.
Dishwash grew 3.7% for the year. Strong double-digit volume growth in both bars and liquids, which is great. But lower average prices due to promotions did hit the margins a bit in that segment. Personal care, unfortunately, struggled a bit, declined 0.9% for FY25. Seems like inflation hit it, plus they had a high base from the previous year. Margot's weakness dragged it down, but they are working on revitalizing it.
Okay. And household insecticides. Any bright spots there, or is facing similar issues?
HI overall declined 6.5% in FY25. But, and this is important, their liquid vaporizers, the LVs, actually saw healthy, volume-led, double-digit profitable growth. They want to keep that going. Coils, though, that's seen as a structurally declining category for them. So the focus there is more on minimizing losses. And again, those new launches, Maxo-Aerosol, the electric racket, are seen as key to future growth and improving margins in the HI segment.
So given this mixed performance across categories and the market backdrop, what's the management actually saying about the medium to long term? What's the roadmap?
Well, commentary suggests they expect demand to improve in the second half of FY26. They also noted that price increases they've already taken across fabric care, personal care, HI, those should start showing their full effect in the second half too. There's a continued strong focus on NPDs, new product developments. They see that as crucial for future growth, alongside organic growth from existing lines. For FY26 specifically, they're guiding for mid-single-digit volume growth in the first half, but are optimistic about potentially hitting double digits by the end of the year.
It's really interesting how adaptable they seem, even when the whole FMCG sector is facing headwinds. They're not just sitting back.
Absolutely. That multi-pronged approach, new formats, distribution, innovation, it shows they're being proactive, not reactive.
But, okay, while the outlook has some positives, no business is without challenges. What isn't working so smoothly for Jyothy Labs? What are the big hurdles?
You're right. There are definitely significant challenges. FY25 was just tough for FMCG overall. You had rising living costs, slow urban income growth, consumers shifting to smaller packs, becoming more price sensitive. Urban households especially felt the pinch, affecting spending on both essentials and discretionary items. And like we said, while rural demand is recovering, it's not yet making up for that urban softness. Management even said April 2025 signals were not very encouraging, so the macro environment is a big one.
Okay, those macroeconomic headwinds are clear. What about pressures directly on their finances, like input costs?
Oh, definitely. Margin pressure from input costs is persistent. Raw materials like Lab Essay, SLES, key stuff for detergents instance, soaps prices shot up some 30–40% year-on-year. Even coconut shell powder costs more. Management expects gross margins to stay range-bound at a high level, meaning they'll manage it tightly, but the pressure is real. And that ties into pricing pressure, too. Intense competition means more promotions, maybe extra grams in the pack, which affects the average price they actually realize per unit.
And competitively, beyond costs, any other threats, maybe from newer players?
For sure. They face threats from the big established FMCG companies, of course, but also from those nimble D2C direct-to-consumer brands. That fuels the pricing competition. Plus, as we mentioned, some categories like coils are structurally declining, so that's a drag they have to manage. And one other point, their working capital cycle increased quite a bit, went from just 5 days to 18 days in FY24.
18 days. That's a big jump. Why?
Yeah, it means more cash is tied up in inventory and receivables. They attribute it to higher raw material prices, a growing share of modern trade, which often has longer payment cycles, and institutional business. They expect it to normalize, maybe settle between 15 and 20 days, but it's something to watch.
Okay, quite a few challenges there. So how are they planning to navigate this tricky environment?
They're sticking to their core strategies, really, launching affordable formats, filling those portfolio gaps, digging deeper in their strong regions, managing costs very carefully. And those new product launches are a big part of navigating, too, trying to drive growth in new areas. They do anticipate some margin pressure here and there in the first half of FY26 because of all this, but the overall goal is still to keep EBITDA margins somewhere in that 16–17% range. It's pragmatic.
Right, makes sense. So now, the big question everyone probably has, what does the market think? And importantly, what did that valuation report suggest about Jyothy Labs? Is it fairly valued?
Okay, let's get into the valuation. So the assessment we looked at used a multiples-based approach. This means looking at standard financial metrics and comparing them. Things like the price to earnings or PE ratio, how much investors pay per rupee of earnings. Also, EBITDA, which compares the company's total value to its operating profit, plus price to sales and price to book ratios, gave a broad comparison picture. Each of these four metrics got equal weight in the analysis, and what it suggests is that Jyothy Labs is currently likely undervalued by the market.
Undervalued, why?
Well, the thinking is it's likely due to those temporary pressures we've discussed, the urban demand softness, the inflationary input costs, things that are affecting sentiment across the whole sector right now. The analysis came up with a blended fair value estimate of rupees 414.41. Adjusting for market conditions, the target price was put at rupees 393.69. Now, compared to the market price around rupees 340 when the report was done, that implies a potential upside of about 16%.
Okay, so those temporary external factors might be creating a gap between the perceived value and maybe the underlying value.
That's the idea. The valuation suggests a reasonable margin of safety for investors looking medium to long term, especially if that volume growth continues and margins stabilize as management hopes. But it's important to remember this analysis was purely based on relative valuation comparing it to peers and its own history on these metrics. It didn't include discounted cash flow modeling or, detailed future earnings projections.
Got it. Still, it's fascinating how those short-term market pressures can sometimes obscure the longer-term picture.
Exactly. It's about understanding those nuances. So maybe a final thought for you, the listener. Consider how resilient consumer behavior often is, even when times are tough economically. And watch how companies like Jyothy Labs adapt their strategies, product innovation, pricing, distribution, constantly adjusting to meet the needs of an evolving market. It's a continuous balancing act.
A great point to end on. Thank you for joining us on this deep dive into Jyothy Labs. And just a reminder, please note that all views presented in this discussion are purely for educational purposes. We are not SEBI-registered financial advisors. If you are considering making any investment decisions, please consult a certified financial advisor.